Two ride-sharing unicorns are entering the final leg of their IPO races. Lyft kicks off its IPO roadshow Monday, while Uber meets with Wall Street analysts next week. So let's go to Deirdre Bosa in San Francisco with more on the story. Hey, Deirdre.
Hey, Melissa. Well, in the early days, these companies, they fielded questions from VCs like, what's your addressable market and who are you disrupting? 10 years later, though, Uber and Lyft are now facing Wall Street to pitch their stories to public market investors, and the questions have evolved. I spoke to a few analysts who cover internet companies like Grubhub, which investors are using as the closest comparison based on revenue multiples and similar marketplaces. It is a far from perfect model, but here are the top 5 things they say Wall Street will be looking for from the ride-sharing startups when they pitch them. One is capital allocation strategy, especially in Uber's case, as it diversifies far beyond ride-sharing. 2, their long-term pricing power. 3, what do margins look like in maturity? Investors also will want guidance on how to think about competition and how they find, pay, and keep drivers in the long term. Now, they also told me that a key metric will be customer and driver acquisition costs. Now, these are all critical questions for both companies that are expected to go public at valuations far above their last private market rounds. Lyft expected to go at $20 to $25 billion. Uber as high as $120 billion. Now, at that price, guys, Uber would be worth more than established names. Amgen, Broadcom, Honeywell, NVIDIA, Costco, just a few of them, just a few of the names that Uber would be valued higher than. So Wall Street is certainly going to want to know how a ride-sharing company with no profits and a yet-to-be-proven business model justifies that amount. Melissa?
Deirdre, thank you. Deirdre Bosa. So here's the question. How is the market going to receive these two unicorns, and will that be the barometer of risk appetite?
Yeah, I actually think the market's going to receive them quite well. I mean, when you look at these businesses, they're asset-light, network effect type of businesses. So they could get a higher valuation, and particularly in this marketplace where we're talking about Google and Facebook. Those are companies that are generally asset-light, at least a lot more asset-light than something like United Technology. I think the ability to pull some levers and get those profitable numbers will help both Uber and Lyft.
But they've already shown that their growth is slowing in the fourth quarter in their filings. So that's because they're subsidizing rides. And if the business is so great, why are they subsidizing these rides? Why is their growth slowing already before they even go public? But if you're picking between Lyft and Uber, Uber has a lot more levers to pull. It's the bigger name in the business. I think they'll both be successful. But ultimately, I'm worried about the growth.
At this stage, though, shouldn't it still be growth at all costs? I mean, acquiring customers, shouldn't that cost something? And in this instance, it is subsidizing rides.
Netflix has done it for, the last, right? I mean, it is growth. Just, it's a land grab until you get to that point. Amazon, so the answer to his question is yes. How do you trade these plays, though? I mean, Steve would probably agree. Intercontinental Exchange, the ICE trades 17.5 times. It's backed off since November, as has the NASDAQ. But I do think these exchanges have a lot of value in the environment we find ourselves in.